Good afternoon, everyone. Thank you all for joining us today for Estate Planning 101 with Teresa Byers, hosted by the Endowment for Equal Justice. My name is Melinda Mann, and I'm the Chief Development Officer for the Endowment, the largest sustainable fund for legal aid in the country, and its partner organization, the Legal Foundation of Washington. I hope you were able to join us for our last webinar, Estate Planning Through a Race Equity Lens, presented by Lorraine Del Prado. We plan to produce that webinar again in the first quarter of 2021 for those who couldn't make it, as there has been much interest in that curriculum. Before we get started, a few Zoom and CLE housekeeping items. This webinar is pending approval for 1 CLE credit. Once the credit is approved, we will submit your attendance to WSBA. It may take 1 to 4 weeks before your credit is reported. Please note that if you're joining by phone, you must self-report to the bar through our activity ID number. The activity ID will be shared in the chat, but it's also listed on our website at www.legalfoundation.org/the-endowment. A recording of this video will be available upon request, and it will also be posted on our website later this week. We will be reserving time for questions in the last 10 minutes. If you have any questions for our panelists during the webinar, feel free to submit them via the Q&A function. We will also try to monitor the chat for any questions that you want to bring to our attention. Before we get started, I would like to acknowledge that we are on the traditional land of the first people of Seattle, the Duwamish people, past and present, and honor with gratitude the land itself and the Duwamish tribe. Again, thanks for joining us. I'd like to introduce our moderator, Attorney Mike Longyear of Reed, Longyear, Malnati, and Ahrens, who specializes in estate planning, tax, and litigation. I'll turn it over to Mike. Thanks for being here.
Great, thanks so much, Melinda, and it's great to be here and welcome everyone to this program and the important topic for lawyers of estate planning and legacy planning. I appreciate the opportunity to be part of the webinar and look forward to the comments and presentation that Teresa Byers will be giving. But before we get started, we'd like to do a very brief 4-question anonymous poll about where you are in your estate planning journey. Many of us lawyers are like the proverbial cobbler's children who are barefoot. So just because we're lawyers doesn't mean that we take the time and put pen to paper to actually do an estate plan. So one of the goals of this program is to get us all thinking about that and making sure that we put our plan into place. I'll give everyone a minute or two to complete the poll. And while you're doing that, I'd like to introduce my colleague and our main presenter, Attorney Teresa Byers. Many of you know Teresa. She's a member of Ogden Murphy Wallace, where she engages in proactive estate planning to help her clients create estate plans that manifest their intent and values, including caring for family members, creating and funding trusts, advising on gifts, and avoiding unnecessary taxes. Teresa also works with tax-exempt and nonprofit organizations and can that be included in their planning. So now I'll turn it over to Teresa, and hopefully by now everyone's had a chance to go through the survey, and we'll get started. So Teresa.
Thank you so much. And thank you all for taking the time to join us today. I'm excited actually to see the survey results, to see if they're any different now that we've been through a year of 2020, how many people have actually updated or done more with their estate planning, because I sure feel like I've been getting a lot of calls from clients this year, whether it's in response to COVID or it being an election year. But I'll be curious to see how many folks within this group have recently updated their plans or put some more thought into their planning. Jessica, do we have those numbers up to share? All right, so 64% have a will. You are far better than the average person on the street, folks. Way to go. Is charitable giving part of your plan? We're getting there. We're getting there. If you have a will, is it updated? Uh-oh, we got a few from like 1986 out there, it looks like. And you have strong feelings. Interesting. So almost the same number of people have strong feelings about what happens to their assets upon their death as do not have an updated will. So hopefully this will be useful information that I'm sharing today. So I'm going to share my screen here, if I can do this properly. And I apologize for not doing it before. I guess I should have been. There's Mike. And we did our anonymous poll. That's me. Okay, so what is estate planning all about and why do we care? So in its simplest form, an estate plan is the process by which your assets will be managed and distributed upon your incapacity or your death. And it's important, even though for today's purposes, we're primarily going to be talking about post-death transfers or testamentary transfers, to just acknowledge that a power of attorney is really something that's quite necessary in order to make sure that what you want to have happen in terms of your care occurs. And by that, I mean both a financial power of attorney, so someone can file your taxes, pay your mortgage, figure out who your credit card carriers are, those types of things, if for some reason you can't. And then also someone who can make medical decisions for you, including a release under the Health Insurance Portability and Accountability Act, including for some people what they refer to as a living will or a healthcare directive, something that provides some explicit instruction and authority about what you want to have happen if you're unable to make your own healthcare decisions. Because just like many of us have strong feelings about what happens to our assets, apparently about 76% of us, I would wager almost 100% of us have strong feelings about how we're treated for medical purposes. For today's purposes, we're going to talk a little bit more explicitly, though, in terms of estate planning, about wills and revocable trusts and beneficiary designations for non-probate assets. In other words, the way that assets transfer upon your death and who they pass to. So what happens if you don't affirmatively write your own estate plan? Well, lucky you, the state of Washington gives you one. So during your lifetime, if you can no longer make decisions for yourself, historically, we've had a process called guardianship in the state of Washington. Starting in January 2021, we'll be having the adoption of our new Guardianship and Conservatorship Act. So guardianship will now refer to taking care of your person, and conservatorship will refer to taking care of your assets. And that is essentially a court-supervised process where someone is appointed to act for you. Because it's court supervised, it can be relatively time consuming. It requires annual reporting, and in that way it can be expensive as well as relatively public. So for most of us, we would prefer to use an alternative to guardianship. And then at death, if you have not got around to drafting up your own affirmative estate plan in the form of a will and or a revocable living trust, the state imposes the Intestacy Statute. And your non-probate assets, and we'll talk a little bit more about probate versus non-probate assets later, they pass according to the contractual defaults in those assets, or in the case of some of your retirement assets, in accordance with federal law under federal preemption. So I want to just take a minute and pause here and remind everyone that Washington is a community property state, and that your estate plan, whether it's the one given to you by the state of Washington or whether one you draft with someone like me, only can pass the assets which you own. So it can only pass your separate property and your half of the community property. And we don't have an obligation in Washington to leave community property to your spouse. It also means that if you don't sit down and think about what your separate property is and what your community property is, and you acquired assets prior to your marriage, or you acquired assets by gift or inheritance, that we may have a little bit of a tussle if something were to happen to you to determine which assets pass as community property and which assets pass as separate property. And that can be particularly problematic under the Intestacy Statute because community and separate property pass very differently under that statute. So why do we care if the state of Washington allows us to default under the Intestacy Statute about having a will at all? Well, probably the most obvious reason is because you want to do something different than what the Intestacy Statute provides for. But it also allows us to make this entire administrative process a lot easier. So the first thing it allows you to do is pick your executor. This is the person who steps into your shoes when you pass away. This is the person who goes through all of your personal information, all of your private files, all of your financial information. They identify your assets, they identify your creditors, they give appropriate notice to creditors, they pay your income taxes and your estate taxes if you have any. And then they're in charge of actually distributing the assets in your estate plan. Now, depending on how long that process takes, they may also be in charge of not only finding those assets, but reinvesting those assets. So marshaling those assets, bringing them in from wherever you had them, reinvesting them in something else during the probate process, and then distributing them out. A will allows you to nominate a guardian and a conservator for minor children. And I'll just point out here, because sometimes this is a point of confusion, it is a nomination. It is not an appointment. So if you were to pass away and we file your will with the court, you're essentially recommending to the court who the guardian of your minor children should be. But the court still goes through its own investigative process, and the guardian is still subject to the guardian and conservatorship laws. So it's not as simple as naming someone in a will and that person wanders off and does whatever they want with your minor children. Your will passes assets that are titled in your name without a beneficiary designation. So this is probate assets. As distinct from non-probate assets. For most of us, that's things like our house or other real property that we own, investment accounts, any business interests that we hold. And this can be a particularly good reason to think about having a will, which is if you have a business interest, you probably have a agreement of some sort that governs that business interest, whether it's a buy-sell agreement, whether it's an operating agreement in general, whether it's a shareholder agreement. And you want to make sure that whatever provisions you put for the transfer of those business interests or the benefits associated with those business interests comply with those other agreements. With your will, you can also create testamentary trusts or trusts that spring into existence upon your death, either for tax planning reasons or because you have family members, often but not exclusively children, who would benefit from trusts. So let's take a minute and talk about different types of trusts. So there's tax planning trusts, trusts that take advantage of the Washington state estate tax exemption, because if you are in the state of Washington, you are subject to the Washington state estate tax, as well as taking advantage of the federal exemptions. Those are commonly referred to as credit shelter trusts. Sometimes you'll hear them referred to as an AB trust, an exemption trust. It's essentially a trust created to utilize your exemption at your death and pass those assets free of estate taxes. When you're creating a trust for a surviving spouse to hold assets above the exemption amount, a trust that's designed to essentially delay the payment of taxes. It's referred to as a Q-tip trust, something like you clean out your ear with, but it stands for Qualified Terminal Interest Property Trust. And those are probably the two most common tax planning trusts that people talk about. They are designed to delay, defer, and avoid estate taxes. Some people also create legacy or long-term or GST trusts, generation skipping transfer tax trusts. Those are trusts that are designed to last for a long period of time to benefit multiple generations while avoiding interim estate taxes. For people who perhaps have an interest in a legacy of education for their family or something like that, they might be particularly interested in those. We have special needs trusts. So if you have individuals in your family who are reliant upon some form of government assistance and you want to provide for them in some way but not disqualify for them for that public assistance, you might have a special needs trust created in your will. We might have a charitable trust that's created. So a trust that benefits a charity on the front end or the back end and individual beneficiaries in the reverse. And then the big one that we think about for most people when we're talking either about children or in my case, semi-adult children that I don't want to use their inheritance to buy a Ferrari if I die tomorrow. We're talking about trusts designed to educate and help our children or our beneficiaries best handle the assets they receive. So this might include trusts for educational purposes, for the key IRS language here is health, education, maintenance, and support. So trusts that are designed to help support our beneficiaries and encourage them to live in a way that we would like them to, which sometimes leads people to worry about the concept of trust fund babies, but it's important to keep in mind that trusts are extraordinarily flexible, that the terminology and the distribution provisions that we put into trusts are really a function of what you want to see happen there. There's very few things that we can't draft into a trust if we need to. On the flip side, trusts are separate legal entities in this context. So a testamentary trust that is irrevocable and springs into existence upon your death is a separate tax-paying entity. It files its own tax returns. It has a trustee. That trustee has fiduciary duties. And so there are some relatively rigid administrative and tax rules that relate to the ongoing administration of trusts. And then we can talk as well about allocating taxes and expenses of administration in your will, or I suppose we could also do it in a revocable living trust, which we'll talk about in a little bit too. Why do we care about this? Well, again, Washington gives you some really nice defaults if you don't give more specific instruction. And those defaults include things like the payment of taxes in a proportionate manner from the assets, which could be somewhat problematic if, for instance, you had a retirement asset that you didn't want to have to pay taxes from that retirement asset because pulling it out was going to result in loss of the income tax deferral. Or it might be that you've got an illiquid asset and you don't want to have to encumber that asset in some way or sell that asset in order to be able to pay the taxes associated with it. So we care about that. We also care about expenses of administration. It's not terribly expensive necessarily to go through probate in the state of Washington. Other states have much more complex and expensive probate systems. I'm particularly myself disdainful of going through probate in California because it seems to take forever and be relatively expensive. But there are still expenses associated with the process of marshaling those assets, paying prior debts, paying estate taxes, and depending on who your fiduciary is and whether they elect to waive their fees, paying your fiduciary. So you might want to be able to put some thought into where it's appropriate to allocate expenses of administration. Your will can also waive the bond requirement that we would otherwise have to probate your estate if you didn't have a will, and you can authorize your executor to operate with what are called non-intervention powers, which essentially means that the executor files the will with the court, initiates the probate process, becomes the appointed executor, and then goes off with all of the power and authority to complete the probate process without needing additional judicial intervention, and then can come back at the end, file a final report, and be done. If you have, in contrast, a full intervention probate, then every action virtually of the executor requires a motion with the court and court approval. So I would like to sell the house that is an asset of the estate. I need to file a motion with the court to get approval to put the house up for sale. I need to give notice. I need to go back to the court once I have an offer and get approval of the offer and the language in that offer. And you can imagine that can create a lot of steps. It can also add a lot of time to the administrative process. So wills are not only the primary means by which we ensure that all of our intentions around the administration of the estate are put in place, but it's also the way we make it less expensive and more expedient. All right, so I get this question a lot from clients, particularly because people have been much more mobile in recent years. They move between states much more often. And so I pretty regularly have clients who come to me and say, oh, my mom or dad, my brother, my sister, my great uncle Joe told me I absolutely have to have a revocable trust and I have to avoid probate. And again, Washington probates can be relatively simple if you can do a non-intervention probate. So using a revocable living trust as a probate avoidance tool in Washington is not quite as critical as it would be in a state with a more involved probate process. However, it's still quite common to use revocable living trusts in conjunction with a pour-over will if you are a resident of Washington. One of the first reasons is because if you own real property, dirt, a vacation home in Sun Valley, Palm Springs condo, a timeshare in Hawaii, in another state, we have to go through probate in every state in which you own real property in your name. So if I'm a Washington resident and I happen to own a farm in Montana and I die with that farm held in my name, I'm going to go through a primary probate in Washington and an ancillary probate in Montana. So one of the first reasons that people create revocable living trusts in Washington is to allow them to put their out-of-state real property into the trust during their lifetime. So this is a lifetime transfer. It's fully revocable, it's fully amendable, it has no effect for income tax purposes. But then when that individual passes away, the trust continues, and therefore we don't need to go through a probate in my example in Montana when I die in Washington. The other reason sometimes people use revocable living trusts is because of privacy concerns. Your will is filed with the court when you pass away. The actual original will is filed with the court when you pass away. And it is a publicly available document. Unless you're Michael Jackson, I don't think most people care to go dig up your will from the courthouse. But if you have an unusual family situation, if you have concerns about publicity or a business that you're involved in, using a revocable living trust might be a good way to avoid someone being able to pull up the dispositive provisions of your estate plan. So finding out who your children are, what the trust for their benefit are going to be. The other reason I sometimes recommend clients use revocable living trusts is if they're going to be moving between states. So like I said before, some states have much easier probate processes than others. If I have clients who are kind of flip-flopping back and forth between Washington and California, I might go ahead and do a revocable living trust in Washington, knowing that they might amend and restate it if they move to California, but that at least they'll have a vehicle that works well in both states. Now, disclosure here, and this is a cause of confusion for many, many people. Just because you have a revocable living trust, it doesn't mean you don't need a will. Everybody still needs a will. It's just when you have a revocable living trust, you have a very, very, very short will. It's commonly referred to as a pour-over will. And it essentially says everything that I own at the time of my death in my own name, basically anything I forgot to put in the revocable living trust before I died, which almost all of us do. We have something that we forgot to title in the name of the trust. We bought a new car, we opened a new bank account. Please take those assets titled in my name, probate them, and then put them in the revocable living trust. So in this type of structure, the revocable living trust is the primary estate planning vehicle. It contains the dispositive provisions of your plan, but it doesn't get you out of having at least a very basic will to make sure that everything gets into the revocable living trust. Okay, so what doesn't a will cover? And by and large, by the same token, what won't a revocable living trust cover? And in today's world, it's a lot of your assets. And all of these assets are included in your estate for estate tax purposes. So keeping in mind that the estate tax system and the income tax system are not friends and they don't speak. Whatever you know about the taxability of your various investments for income tax purposes is irrelevant for estate tax purposes by and large. So your retirement assets are included in your gross estate for estate tax purposes. Your life insurance, if it is held in your name, is includable in your estate for estate tax purposes. The same is true of any of these other assets listed here. It's also the case that all of these assets are what are called non-probate assets. They're assets that are contractually based and they pass by a beneficiary designation. For example, when you have your 401k or 403b or your IRA, your Roth IRA, you'll be asked to fill out a beneficiary designation form. And it's that form that dictates where your assets pass, where those assets pass when you die. You don't actually have a provision in your will if it says all of my assets to my spouse. That actually doesn't control your retirement accounts. It doesn't control your life insurance. So it's really a critical part of any estate plan to sit down and divide out your probate assets, the assets that are going to pass under your will, and your non-probate assets, the assets that we need to look at the beneficiary designation or the underlying contract and make sure that those assets pass in accordance with your plan. A couple other things to note about these assets. So retirement accounts and life insurance, it's pretty easy to see that you're going to have a beneficiary designation form for those. People often get really confused with joint bank accounts and investment accounts, not understanding that a joint account is often shorthand for what's called a joint tenancy with right of survivorship account, a JTWROS account, and that is the default for many of the financial institutions. And if you have a joint bank account, a joint tenancy with right of survivorship account, that account passes outright to the surviving joint tenant without probate. It does not pass under your will. And while that might be great for ease of administration, it can be really terrible for tax planning. And it also just might not be what you intended at all. So it's really critical when we're talking about this process to go through and look at the titling of all of your assets. Don't assume that an investment account or a bank account that is held in the name of you and your spouse is held as community property, is held as husband and wife, when it's in fact held in joint tenancy with right of survivorship. Pensions, these generally have a death benefit. Again, you have to fill out and complete their forms. You're not going to be able to describe in your will how you want that pension to pass. Annuities, and then employer benefits. And this is particularly important for city, state, and federal employees because there's a lot of different employer benefit programs. And sometimes you'll fill out the beneficiary designation form for one program and not catch the other one. So it's important to make sure you do that. What happens if you don't fill these out? If you don't fill out your beneficiary designation forms? Well, each of these different assets has a contract that controls it. And that contract is dictated by the financial institution who's acting as the custodian of that asset. So if it's a retirement account with Vanguard, Vanguard's custodial agreement has default provisions for what happens if you don't fill out your beneficiary designation form. So it's important to understand that not filling the form out is making an affirmative decision about where those assets are going to go. A few other things to keep in mind: retirement assets, if they're federally controlled retirement assets, 401k or 403b, those have some federal guidelines applicable to them, particularly with regard to spouses. And it's also important to keep in mind with all of these assets that because Washington is a community property state, even if one of these assets is titled in your name, your spouse still has a community property interest in that asset. So as an example, let's say that I have a 401k account that has $100,000 in it. And I've acquired the entirety of that 401k during the course of my marriage. Well, my husband has a $50,000 community property interest in that retirement account. So even though it's in my name, if one of us were to pass away, we still have to figure out how to account for that $50,000 interest. And sometimes it's by what's called a non-pro rata allocation of other assets. Sometimes it results in splitting of accounts. So it's really important to understand the character, the separate and community property nature of your assets, as well as the type of asset, whether it's a probate or non-probate asset. Okay, so this is the kind of meat of where we are today. Now that I've scared everyone into thinking that they need to go back and look at this stuff again, and did they really understand their plan in the first place, what else might trigger you to think about updating your plan? Well, My general rule of thumb is after 5 years, you should have your plan out on your coffee table. And once a year, you should have a cup of tea or a glass of wine and you should read through it. And the reason for that is because most of us have changes in our personal life that happen with some frequency. So separate and apart from anything that happens at the state or federal level with taxes or legal changes, we just have people in our life that come and go. So you may find out that the person that you named as your executor or the guardian of your minor children or the trustee of the trust for your kids or the special needs trust for your sibling is not the right person to act anymore in those roles. Or it may be that they've moved out of the country and now we have issues with foreign trust law that we don't want to deal with. It may be that they've had, children of their own and they don't have the time to handle those things anymore. So that's one reason to take a quick look at your plan. You have changes with your kids. So most of us do some initial planning when they're essentially in diapers and we don't know that much about their personalities yet. You know a whole lot more about their personalities by the time they're 17, but that may not mean that you want them to receive the entirety of a life insurance policy and your 401k when they turn 18 because they're going to go use it on a Ferrari. So we might need to think a little bit about what the kids are likely to do. We'll know more about whether they're the type of kid who's going to go to Stanford or the type of kid who's going to go to some sort of trade school or the type of kid who's going to go work for the Peace Corps. And we want to modify our plan to address those changes as people grow and change themselves. New assets. So estate plans are drafted to be flexible and be accommodating. We don't name particular accounts usually in an estate plan. We don't obligate you to keep all of your bank accounts with the same bank the whole time, but people do change the character and the type of their assets. If you invest in a new business and that business has restrictions on what can happen with those shares. You invest in a business and suddenly it's worth a whole bunch more money than it was before. And now we need to do some new tax planning. If you have a substantive change in your assets, it's worth taking a look at your estate plan and really thinking about what's the best way for that asset to be addressed in the plan. Beneficiary designations. I know I'm just harping on this one, but I get so often from people, did anyone ever tell me how to fill this thing out in the first place? And I think part of this is because for many years, those non-probate assets weren't all that significant of a part of a lot of people's estates. Retirement accounts are huge now, but it's taken a while for them to get there. And they're a hard asset to plan with because of the restrictions under federal law, and because those laws keep changing. And so it may be that a beneficiary designation that you had made really good sense in 2005 or in 1996, and it may not make as much sense under the current law. Maybe because you now need tax planning in your documents and we need to update the beneficiary designation to go to a tax planning trust. Maybe it's because at the time that you did that, that account was much, much smaller, and now it's much, much larger and proportionately more of your plan. It may be because you got married and you have a pre or post-nuptial agreement that obligates you to do something in particular with one of your assets, or a child support order that obligates you to do a particular thing with your assets. So when you're thinking about updating and reviewing your estate plan, it's not just about taking a quick read through the will or the revocable living trust. It's about going through each of those assets individually and confirming that you've got the right beneficiary designation. And then we talked a lot about this at our last meeting with Lorraine. And this is changes in your charitable values or the ability to act on those values. Now, sometimes those changes might be because you were lucky enough to have an increase in wealth, or your kids are now old enough to be independent and you feel freer to gift to charity. Or it might be because you've had a change in your thinking about charitable giving and what charitable giving means. And maybe it's time to start thinking about charitable giving as a way to actually benefit your family by benefiting society at large. I don't know. It could be any of those things. It could be others as well. But it's okay to have our values change over time, either because of changes in our family or because of changes in our education and our thinking and our viewpoint, or because of changes in our own financial status. And I encourage you to take the opportunity to kind of put those racial and social justice lenses on and look at your plan specifically through those lenses and think about whether or not you need to make changes. And they might be small, they might be big, but it's a really valuable way to spend some time. And it can be a really valuable discussion to have with the other stakeholders. Some people are very, very quiet about their estate planning. They don't want to have those conversations with their extended family members. And I certainly respect that. But I have found in recent years when I've encouraged clients to have conversations with their stakeholders in their family that they've learned a lot about their family values, about what the people they care about value, and how they would actually like to receive an inheritance, what they would like to be able to do with that inheritance, or who they think should benefit. And you can always, not act upon those statements by other parties, but they can be very educational. And I encourage you not to hide away from that. The other thing to talk a little bit about here is a more specific piece of that, and that's the SECURE Act. 2020 has been a heck of a year. We've all had plenty of things to worry about, but at the beginning of the year in January, the big news was the passage of the SECURE Act. And I have a feeling that's kind of fallen by the wayside with everything that's happened since then. So I just wanted to take an opportunity to mention that specifically, because particularly with regard to retirement assets, this is a big change. So historically speaking, either by passing a retirement asset to an individual beneficiary or into a qualifying trust, you could have that retirement asset stretch over the lifetime as calculated by the IRS mortality tables of that beneficiary. In other words, your required minimum distributions on those tax-deferred accounts were relatively small, and you could continue that income tax deferral. The SECURE Act changed that. So unless you are a surviving spouse receiving it directly or in a qualified trust, or you are a disabled child, or one of the other few exceptions, the new rules require that those retirement assets pay out within a 10-year period. So that income tax deferral over the lifetime of the beneficiary is gone. And the vast majority of estate plans that have any sort of testamentary trust for children that was anticipated to hold retirement assets have specific provisions related to the distribution of income and required minimum distributions. Now that we've got this new 10-year payout plan, there's no longer required minimum distributions for those beneficiary plans, and that income tax deferral is going to be gone within that 10-year period. So it's probably time to look back and say, first of all, do I still want these retirement plans going into a trust at all? Is that still the right thing for me? And it very well may be, because of the way your family situation works out, because of your tax planning, whatever it is. So this is not to discourage you from using retirement assets in testamentary trusts. It's rather to understand that some of those benefits are no longer there, and that the trust language itself may need to be rewritten. And again, this was something that just had a ton of attention early on and has kind of faded in people's minds, and I wanted to bring your attention back to. Okay, quick reminder about estate taxes. I'm not going to sit here and describe all of the ways to minimize state and federal estate taxes, but it is a good opportunity just to remind you that Washington State is one of the few states that continues to have a state estate tax. Our current exemption is $2.193 million. It's a $2 million exemption that was indexed for inflation for a couple of years and is now stuck because of a change in the CPI index. I don't see the Washington state estate tax going away anytime soon. And it does bring in, a not insignificant amount of income to the state. So if you have assets in excess of 2.193 million, and this includes, again, all of your life insurance, all of your retirement accounts, your house, your bank accounts, your business interests, you probably should be thinking about and having some conversations about whether or not tax planning is appropriate for you. Separate and apart from that, and the Washington state estate tax rate is between 10 and 20%. It's a sliding scale, so just to help you quantify the cost of this. The federal estate tax and federal gift tax, this is the old concept of the unified credit, is currently 11.58 million per person. That's a big number. And it means that relatively few people have to file in federal estate tax returns and pay federal estate tax in the current environment. A couple of things to know about this, though. The Washington state estate tax and the federal estate tax systems are no longer connected. It used to be back prior to 2005, they were a connected system. They are not. So your Washington state estate tax planning and your federal estate tax planning are different. They require different elections. The other thing to know is that the federal estate tax, for lack of a better way to put it, it's more variable perhaps than our Washington state estate tax. The current federal estate tax is slated to expire in 2025. So that would take the federal estate tax exemption and gift tax exemption back down to 5 million. Depending on who wins the election this year, we may have either an extension of that or a reduction in that timeline. And there's also plans to eliminate potentially the step up in basis that is associated with folks passing away. So the estate tax playing field is changing, and it's a big deal. It's a 40% tax rate at the federal level currently. Historically, it was as high as 55%. So if you have an estate that may be creeping close to 2 million, 5 million, 11 million, it's a really good idea to think about doing some tax planning. There is very effective tax planning that can be done. Some of it is done in your will or your revocable living trust. Some of it is done during your lifetime. And as with most things, the earlier you start, the more successful you'll ultimately be in doing that planning. So let's talk a little bit about the benefits of charitable giving. Now that I've scared everyone with estate taxes, one of our favorite ways to avoid estate taxes is to make charitable gifts. It's also a really great way to avoid some income tax, but that's not the reason we do it, right? Honestly, the reason that we engage in charitable gifting has much more to do with how it makes us feel, how it's a reflection or expression of our values, wanting to effectuate change in our environments, and then we get to perhaps tax efficiencies. Again, income tax deductions during your lifetime and estate and potentially income tax deductions upon your death. So if we're looking at charitable giving this year, is there anything particularly interesting in 2020 about charitable giving? Well, maybe. So I'm going to highlight just a few of kind of the easy first steps. Now, this is not to say this is by any means an exclusive list or that this is the way you're going to make a great, big, huge charitable deduction. This is more about, is there something I should be thinking about right now that I can kind of do on my own? And one is the CARES Act. So this was the act that was passed in response to COVID-19. It's interesting because you may remember that there were changes in the income tax laws that changed how charitable deductions worked. And under the CARES Act, for this year only, if you give cash donations up to $300, you can get an above the line deduction even if you're not an itemizing report. So, might as well take advantage of it. Might as well help your kids take advantage of it. Make some annual exclusion gifts and tell them to go give some of it to charity. Spread the wealth a little. You can certainly see the benefits to it. It helps people feel more engaged. And I think that's a big part of when we're talking about looking at giving through a racial and social justice lens. There's a part of it that needs to be allowing everyone to participate or allowing more people to participate. So think about that. Qualified charitable deductions. So this has to do with your retirement assets. Congress, again, extended the ability to make direct gifts from your retirement assets to charity. That avoids that income tax recognition on the transfer of those assets. And it can be a great way if you're not utilizing those retirement assets, you're over 70 and a half, or you have a client who's over 70 and a half and is not needing those retirement assets, to go ahead and start making change now, and minimize the income tax effects for them. Gifts of appreciated stock are always great charitable gifts, because if you sell the stock yourself, you're going to trigger and recognize your capital gain. If you make a gift of the appreciated stock in kind, the charity doesn't have to pay tax on it. So those are great. And with the way the stock market's been lately, you probably have some losses that you want to personally harvest, and you may have some gains that it's appropriate to go ahead and pass off to charities. Required minimum distributions, again, if you don't need them, they make great charitable gifts. And then this last one is one of my favorites, because I find that it's a way for people to kind of ease into charitable giving. And this is updating your beneficiary designation on retirement accounts, particularly the smaller ones. So most of us have had, over the course of our lifetimes, more than one employer, and we might have not got around to consolidating, or may not be able to consolidate all of our different types of retirement accounts. And for some people, it's hard to make the step to say, I'm going to give 10% of my estate to charity, or I'm going to give 20% of my estate to charity. And they don't necessarily want to pay to update their will or their revocable living trust. But it's really easy to update a beneficiary designation. And if you have a isolated one-off account like this, update the beneficiary designation, super easy for the charity to claim it upon your passing. Not something you have to write into your will or your revocable trust. Might be an easy conversation to have with the other stakeholders in your plan. And it's something that you can change anytime you want, right? If that account becomes too large, or it becomes too small, or you want to add another one, again, it's pretty easy to make those changes. So I would encourage you to think a bit about that as well. Mike, I just saw you came back up. Was there a question?
No, I think we're at the point where I need to introduce our next speaker. So.
Perfect.
So thank you, Teresa. That was great, and lots of questions that we'll pick up with after our next presentation by Gail Mountainer, who's going to share some information about the benefits of charitable giving. So, Gail.
Hello, hopefully people can see and hear me. Somebody say yes or no, or wave an arm. Okay, hello Teresa, you did great. Thank you so much. So my name's Gail Mountainer. I joined the Endowment for Equal Justice Board about 1.5 years ago. And I did it because after sporadically doing various kinds of volunteer, pro bono legal work, social justice work, I looked at the endowment as a way to really express my commitment to access to justice for everyone, not just those who can afford a lawyer. Right now in Washington, only 1 in 4 people who need civil legal aid can actually access it because of resources and the lack thereof. So the endowment works to change all of that. The Endowment for Equal Justice plays a unique role in the legal aid network in Washington because it's the only long-term, truly sustainable source of funding for civil legal aid. There's lots of other various sources, and some years they do well, and other years they don't do quite as well, but the endowment is the stable, consistent one. It's also the largest fund of its kind in the country, founded in the year 2000 by attorneys who recognize that IOLTA rates on trust accounts and public funding can come and go and be there and then maybe not be there, and that puts consistent provision of legal aid at risk. The endowment began making distributions 6 years ago, and between then and now, the endowment has distributed more than $4 million for legal aid services in Washington. It's become a critical source of unrestricted funds, which can be used to help both undocumented people, people involved in the criminal justice system, and people involved in the civil legal aid need world. So that's why I'm on the board. I also want to talk and tie a tiny bit back to what Teresa talked about in terms of the different methods, because we know that there are different reasons we give to charity, and tax, as Teresa said, is the least of those. And I'll talk a little bit because maybe people can resonate to some of my story. Decades ago, my husband and I did the world's most simplest wills when our children were tiny and he was about to have surgery. And even though I was a lawyer, I didn't yet have a will, but he was about to have surgery. We both did wills. Our children were under the age of 3 years old at the time. They are now 30 and 33. And shoemakers' children have no shoes. I had been one of those. I think the poll said maybe 75% of people who had a will and had not updated it. And so in addition to starting to chew on my husband to let's update our wills, our kids are grown, I also looked at those different charitable methods and picked the one that worked for us, which is, while I was busy getting a real will in order, I did the very simple basic thing of going to the HR team at Lane Powell and updating the beneficiary designation on my 401k. And you can do that in pieces and its entirety. And mine is now in pieces to different charities that I believe in and to my family. And it's done by percentages. And the Endowment for Equal Justice has been added to mine. And so when you think about why you give to charity, it makes you feel good. It demonstrates your personal values. It's now more than ever needed. And when you walk the walk, you can model for your children, whether they're young or adults, how you make your vision of social justice something that's real. And that's a good thing. And if you talk about it lots and lots, as I do from time to time, you really have an impact on the people around you because they see that it's not weird. It's not just for multimillionaires or millionaires, but regular people can do something pretty straightforward that helps. So that's my plug for charitable giving in general, and an explanation, I think, of why I picked Endowment for Equal Justice as both a commitment of time during my lifetime and as a recipient of a piece of my estate after I'm gone. So thank you so much for listening to the seminar, listening to me. We all hope that you will think about your charitable goals, and I will kick it back to Mike and Teresa for the Q&A part of this.
Great.
Thanks so much.
Great. Thank you so much, Gail. And we have some time for a Q&A. There's been lots of questions coming in, and Teresa, maybe kind of give the overview of what's included in a taxable estate.
Sure. So your gross estate is very literally everything you own. So if we're going to give some examples, it's your house, your bank accounts, your retirement accounts, the actual death value of any life insurance that you have. So if you have $1 million policy, it's not the $4,000 premium payment that you make, right? It's the $1 million. It's going to be any business interests you have, and those have to be valued. It's going to be any tangible personal property you have. So if you're like me and you have lovely art created by your children and you would like someone to value that art, that gets to be included. Your grandmother's pearls, those fall under it as well. So that's what's included in the gross estate. What's actually included in the taxable estate is a variation of that, right? So we allow deductions for certain things. We essentially defer taxes if you leave assets to your spouse in certain ways. So that might reduce the initial estate tax liability. We do charitable deductions. So if you're leaving something to charity, we give you a break on that. We don't tax that. It may be that there's some deductions for debts that you had or expenses that need to be paid. But in general, when we're talking about your estate, we're very literally talking about everything. Washington State has some percentage allocations if you're talking about direct ownership of out-of-state real property, but we tax your worldwide income and your worldwide estate in the US. So to think about it in that same kind of way. If you're a US citizen, we are happy to tax you.
And Teresa, as a sort of follow-up on that, you want to discuss the 6-month alternate valuation date for estate tax?
Sure. And this is another one of those years where it could be a big one. So your estate is valued as of your date of death. It's a snapshot in time. So if the market falls the next day, too bad. If it fell the day before, too bad. It's that snapshot in time with a single exception. And that is that you can elect to use an alternate valuation date that is 6 months after your date of death. And this is really, it only works if the estate is less, if the gross estate is less 6 months after your date of death than it was on your date of death. We don't let you go up, we only let you go down. Not that I can imagine why anyone would want to pay more estate tax, but just to say it out loud. And so for people, for instance, in 2008, we had a lot of people who, particularly who were invested in real estate, where the date of death value of their estate was quite a bit higher than the value of those assets 6 months later. And so we use the alternate valuation date. The same is true when you have years like this year where you have kind of a rocky stock market. I've got a number of estates where it made good sense to go ahead and use the alternate valuation date for the purpose of reducing the value of the gross estate and then the taxable estate for estate tax purposes. You do have to be really careful though. If you sell assets within that 6-month period, it's the sale value. So you don't get to go back and recreate. And so if you're thinking that you might be using assets or might be using an alternate valuation date, you need to be working with good legal counsel to make sure that you're following all the rules.
Right. And to that point, you don't get to pick and choose.
No, it's all or nothing.
Okay. A question about deductible expenses for estate taxes, cost of administration, that kind of thing, burial, funeral expenses, that sort of thing.
Yeah, so some expenses are deductible on the Washington State estate tax return, some are deductible on the federal estate tax return, and some can be deductible for income tax purposes. So one of the other things that's really important to do is figure out who's going to be filing your income tax returns as well as your estate tax returns, and have those people run the expenses on both to figure out where you want to take them. And we're including in this process things like burial expenses. We're including attorney's fees, accountant's fees, fiduciary fees. So for instance, if you have a professional fiduciary or even a non-professional fiduciary and have fiduciary fees there. Maintenance expenses. So if you have real property and there's some sort of maintenance associated with it, real property taxes. It's really important anytime that you're a fiduciary of an estate, an executor or a trustee, to keep really, really good records and receipts, because we take all of that information, plug it into these various returns, figure out where we can take it and where it makes the most sense to take it. And it used to be that everybody looked at estate taxes and said, well, it's a 55% tax rate. Of course, that's where we want to take those deductions. But now, if it's a Washington State estate tax and you're looking at a 10 to 20% versus an income tax issue and you're in the 35% bracket, you may want to think through that a little. So I would say the complexity of the process has perhaps increased a little, but what hasn't changed is that you really need to keep close track of those expenses and have good documentation.
Tax returns, state tax return is due 9 months, but let's kind of talk about that a little bit more. What about extensions, that kind of thing?
Sure. So both Washington state and federal estate tax returns are due 9 months after date of death. You have the option of filing a 6-month extension, but that is for the filing of a return. It does not change that the actual estimated tax payment is due on that 9-month date. So it's very important to figure out early on in the process whether you're going to have a taxable estate and figure out how you're going to have sufficient liquidity to pay that tax at the 9-month mark. And, you know, most of the time your guesstimates at 9 months can be pretty good, not always. So you might have a hard to value asset. You may still be trying to figure out the alternate valuation date values, right? If you decide to go with the alternate valuation date, which is 6 months after date of death, now you've only got 3 months to get your valuations done. So sometimes those numbers change a little bit, but you want to make sure you get that estimated tax payment in because the penalties and interest are pretty awful.
And since we're here today talking about charitable giving, how are estate bequests to charities, how are they factored into that calculation for the estate tax return?
So they actually come out as a deduction. Charitable bequests come out as a deduction. They're generally, most people include specific provisions in their documents to make it clear that it's their intention that any charitable bequest is exempt from estate taxes. So even if there's estate taxes owed on the estate, not only do they want to claim the charitable deduction, but they want to make sure that there's no allocation of tax to the charitable share. So that's another reason why it's important to, if you're making a charitable bequest in your will or your revocable trust, make sure you've got all the appropriate language in there. This is one of those areas where probate and non-probate assets matter, right? So if it's a non-probate asset, the charity can go directly to the custodian of that asset and claim it, claim the 401k, claim the IRA, whatever it is. If it is a charitable bequest under the will or the revocable living trust, they're going to be waiting through the administrative process to be able to claim that asset. So the payment of and distribution of an estate, if it's taxable, for most people does not happen until certainly after the estate tax liability has been calculated. And a lot of times it's not until after the initial payment's done. There might be an interim distribution, but there's going to be a holdback to make sure that you get through the statute of limitations on that estate tax return, which is a 3-year statute of limitations for both federal and state purposes. So if you think about it, let's say you do 9 months from date of death plus a 6-month extension, and now you've got 3 more years from your filing date. It can be a long time that you're waiting to get clearance. So that's one of the things to think about is kind of the immediacy at which people are able to, or charities are able to recover those assets.
And sort of bringing that around in terms of including charities in as part of an estate plan, what's been your experience perspective on having that dialogue with a charity and making your charitable intent known?
You know, it really depends. By and large, I've had a really good experience with it. Most charities are incredibly grateful. They care about their donors. They want to make them feel part of their community. They want to celebrate them during their lifetimes, because this is one of the hard things about death in our society, right? We celebrate people when they're gone. They never get to hear all the lovely things we say at their funeral. And it's the same with charity, right? The charities want to celebrate you while you're there and can be part of that community, can be part of their story. So I see some real benefits to it. It is important to understand, though, that people can change at any time. And so sometimes people are a little uncomfortable feeling like they're going to be tied in to a representation that they make. I haven't found that to be particularly true. I haven't had the experience of an individual trying to change a charitable bequest and someone saying, oh no, you're locked in. You know, this isn't a pledge. A bequest is distinct from a pledge. So I generally think it's a nice way to allow people to engage in a charitable community that they care about.
And I just kind of bringing it around with a legal foundation and the types of programs that the foundation supports and participates in, it'd be a great way to connect to make sure that your intent and goals are being honored and participated in as part of your planning process.
Sure. I mean, I certainly think it offers you a chance to have a real-time dialogue about what type of change and what you envision and what goals you have.
Very good. Well, I think we've gone through all of the questions here. And so I want to thank everyone for joining us today. And Teresa and Gail, thank you both for your participation. And that was a lot of excellent information in a very concise time. So again, thank you. And Melinda, anything else we need to touch base on other than that this program has been recorded and will be available on the website for the Legal Foundation. So if you want to go back and follow up with some of the comments that Teresa and Gail have made and some of the questions that have been discussed, it's available for you.
Fabulous. Thank you so much, Mike, Teresa, and Gail. We so appreciate you joining us. And if you have any questions for the foundation or the endowment, please get in touch with us. Thank you.
Thank you.
Thanks so much. Have a great day.
Yes, take care, everyone.